So in relation to Landbay, and again, I think this will be quite common across the industry, for mortgages to be securitized, it is very challenging to do desktop valuations. You need either, if you don't have physical valuations on every single property, regardless of LTV, regardless of remortgage or purchase, etc., either they are not really securitizable, or in effect, a heavy penalty is applied to them from the rating agencies and buyers that will then question the validity of those valuations. So in a time when the securitization market is closed, to put yourself in a position where actually, if we get to a point where we can come to market in an expensive, we're penalized even more because there has been an absence of physical valuations. It just makes that, in that funding structure, even more uneconomic than it is today. And particularly for US investors and US banks, etc., to be involved in securitization, I think under Dodd-Frank, they have to have physical valuations. It doesn't really matter, even if they're 20% LTV, the US Fed or the US government has insisted that they do it. So it's something we are, and I'm sure all lenders are, we're looking at how we might be able to incorporate it in the future. But right now, in terms of as it stands, we have no ability to. And I think, as you've seen from other lenders, particularly non-bank lenders, that they're all in a similar position where, you know, that they're not instructing valuations, whatever the LTV, whether it's remortgage or purchase.
Can I say something on that as well? I think I was struck by some of the similarities, but for different reasons, as we emerged out of the credit crisis and markets. So 2012, 13, 14 started operating again. We actually had a shortage of valuers in the market. Well, we have a shortage of valuers in the market. Average age of valuers today, I think it's around about 60. So it's the aging population of valuers. And so we were seeing shortage of valuers 2013, 14. One of the outcomes for that was use of AVMs, use of desktop valuations by some of the largest lenders. And I think it's got lenders thinking about what are the properties that, or where are the real risks and where do we want to focus our time? So I think you could make a case for standard construction properties nowhere near high risk areas like floodplains, mining and subsidence, in or around sort of conurbations where the economy is easy to understand, having some sort of desktop type valuation, or maybe supported with an AVM, particularly if the LTV is low. And then you focus your efforts on those cases where you really do need to have a valuation, where it doesn't fit any of the above: larger loans, higher LTV, non-standard construction, high risk areas. And I think that has been the case for a while. And I think maybe this is just going to exacerbate it and maybe get some focus back on that again. There have been a lot of technology moves in the valuation markets in the last 5 years. And I think we could do with some more of them. So yeah, I expect some changes.